I'm Charlotte McLeod with the Investing News Network, and here today with me is Rick Rule, proprietor at Rule Investment Media. Thank you so much for joining me online. It's great to see you.
Charlotte, I'm delighted to be back. Thank you for having me back.
Of course, we always like to have you on, and especially at the end of the year so that we can hopefully look back at some trends in 2022 and look forward to 2023. So as I was getting ready for this interview, I took a look back at an interview we did about this time last year. And you told us that the resumption of the precious metals bull market was inevitable. But of course, getting the timing is tricky. So to start out, if we could check in with you on where we're at in that cycle.
Yeah, I'm still bullish about precious metals. And while certainly the thesis to the upside hasn't played out, the damage that was done to portfolios in precious metals was certainly less extreme than the damage that was done in other sectors, which is to say, at the very least, it treated you less badly than other sectors had. Charlotte, the arithmetic around precious metals, particularly physical precious metals, I think continues to be very attractive. Precious metals have done well for a millennia during periods of time when people were concerned about the maintenance of purchasing power in their conventionally denominated savings assets. And as we talked about last year, there is nothing that makes people more nervous than having the interest rate that they're paid on their savings be less than the rate of inflation, which is to say having their bonds guarantee them a loss of purchasing power. In the US 10-year Treasury, as an example, the world's most liquid savings instrument, the US government proposes to pay you 4% in a currency that, by their own admission, is deteriorating in terms of purchasing power by 8%. Our mutual friend Jim Grant calls that return-free risk. So I continue to believe that gold is fighting return-free risk, a fight which I continue to believe it will win.
Okay, I think that is a great sum up, and those are things that people are definitely worried about right now. We've spoken about what's going on with the gold price throughout the year. If you had to sum up gold's performance in 2022, how would you do that? And as we look forward to next year, what are the factors that you will be watching most closely when it comes to gold?
Gold performed less well than I had hoped, but better than I had feared. The truth is that we have lived through a period of 40 years, Charlotte, a fairly benign economic climate. And people are much more confident than they were in the decade of as an example, 70s and the early part of the decade of the 80s. I suspect, although I don't know, that when the arithmetic of our current situation, debt and deficits, out of control government spending, negative real interest rates, which punish savers. I suspect that as those factors come to mind, that gold will become relatively more attractive than it has become. It's important to note, too, that gold is a very, very small asset class. You don't need to have an awfully big move from, as an example, bonds to gold to have an outsized move in the gold price. And that's precisely what I think is going to occur. When will it occur? I actually have no earthly idea. It's interesting too, Charlotte, and I think we talked about this in the past. You and I both attend conferences where there is a group that looks forward to markedly higher gold prices. I've had people chortle with glee, saying that they thought that the gold price could go $10,000 to $10,000. Imagine the set of circumstances that would cause gold to go to $10,000, and imagine the impact of those circumstances on the rest of your life. I'm in the odd position of thinking that gold will do very well and hoping that it doesn't.
Yeah, you do often remind us of that. And that comes to my mind all the time now when I hear these very high gold price predictions. I think, oh dear, like that would actually not really be very good for us probably. So when we think about demand for gold and interest in gold, one area where we have seen interest this year is from central banks. So I wondered if we could talk about central bank gold demand and what that should maybe tell investors about what's going on in the sector.
I think there are at least two, maybe three things that need to know about central bank gold purchases. The first is that countries around the world are becoming weary of and afraid of the interference by the US government in their own internal affairs and the weaponizing of the dollar, the weaponizing of the world's reserve currency, and the attempt by the United States to freeze their political enemies out of the SWIFT banking system, which is allegedly an international rather than a US institution. There are countries that have policies that they believe are in their interest, and they believe that the US attempt to suppress those policies are not in their interest. And the idea that their economy, their method of transaction, should be denominated in the currency of their enemy is not attractive to them. Individual investors, too, I think, need to decide, particularly Americans, if the increasingly intrusive role of the US government in their own private affairs isn't at least somewhat distressing. The idea in your country that political opponents of your prime minister could have their accounts frozen, were they at least denominated in Canadian dollars and in Canadian savings institutions, should lead investors to have the same fear of their own government that foreign investors have of the US government. The second is that I think that central banks around the world are aware of the precarious nature of their own nation's finances. The Bank of Japan, as an example, with extraordinarily high levels of domestic debt and historically high deficits. If you don't trust your own finances, you certainly trust your neighbor's finances less because you know less about them. And I think one of the things that you're seeing in terms of central bank purchases of gold is that they are less inclined to purchase sovereign bond issues of other countries simply because they're concerned about the precarious nature of their finances. Imagine yourself having a wide range. Let's say that you are Premier Xi of China. Imagine yourself looking at the United States and having conflict with the United States in various aspects. You don't trust them. You also don't want to finance them. You don't want to give them the benefit of seigniorage. But in particular, you don't want to be paid 4% on your savings in a currency that's depreciating by 8% a year. The idea that you are subsidizing somebody who is at least in some measure your enemy, and also somebody who is exhibiting increasing credit deterioration, makes the actions of central banks in buying gold very easy to understand. What I would ask individual investors to do is apply the same methodology. Are you afraid of your own government? Do you think that your own government is spending your money wisely? Are you afraid of intrusions by your government into your own affairs? And do you think that your government compensates you adequately for the risk that you're taking in lending them money? If the answers to those questions are no, then perhaps you need to take into account the actions of the central bank, or central banks, pardon me, and employ them on your own behalf.
Okay, so those are definitely good points for us to consider. And when it comes to central banks and central bank interference, can you tell me how central bank digital currencies fit into that picture and what we should be keeping in mind when it comes to that?
Well, central bank digital currencies, to me, are incredibly scary. The idea that they could issue an unlimited amount of currency units without regards to the market, which is to say they wouldn't have to borrow it, they could simply counterfeit, print. And scarier still, that they could cancel your currency units. If the government took objection to some action by Charlotte McLeod, perhaps she gave a campaign contribution to the wrong party, perhaps she backed a philanthropy that the government considered to be anti-Canadian, they wouldn't have to freeze her bank account. With the central bank digital currency, they could simply cancel her currency. When you combine that technology with the Chinese technology of social scoring, which is to say that the government looks at your actions and decides that they've been helpful or non-helpful and assigns you a social score. The combination of the technology around controlling the currency digitally and then ranking people according to the government's priority becomes, to me, a truly terrifying circumstance. I've even taken now to spending cash in circumstances where in the past I would have used credit cards, simply because I'm looking to increase the utilization of cash through society, because I'm afraid enough about the conjunction of central bank digital currency and social scoring that I would like, in my own small way, to make cash itself more useful to more people.
So this is going down a little bit of a scary path there. Usually you tell us, it's not all bad. Things will probably turn out okay. What do you think about this? Is this an inevitable path that we're going on right now?
No, I think it probably will turn out okay, but I think it's a contingency that's worth insuring against. I don't believe that society gets better because of government. I think that society gets better in spite of government. Wealth isn't created. Progress isn't created by government. Wealth and progress are created by individuals. And we still, in the United States and Canada, have a society that's diverse enough and creative enough that we generate so much individual wealth that we can afford our collective stupidity. And I believe that that's going to continue to be the case. But I'm beginning to insure against the odd circumstance where it might not be the case. Certainly, irrespective of whether you agree with the protesters' actions in Ottawa, the extra legal response of the Trudeau government was, to me, absolutely terrifying. I'm used to being more afraid of my own government because they're closer to me than other governments. But I think what Mr. Trudeau did was express the will of big thinkers around the world. I think probably President Biden looked at Prime Minister Trudeau with some envy. And the fact that it was his attempt to deprive you of your freedom that inspired such envy from my president, that's not an attractive circumstance for me. I still believe that individually, we have the tenacity and the brilliance to outthink the bastards, but just in case.
Okay, that context is very helpful. So as we speak today, it's December 14th. We've just had the Fed finish up its latest meeting. So I think we're pretty much obligated to talk about that. You've been telling us throughout the year that you think the Fed will keep hiking basically as long as it can, and it needs to, so that eventually it can pull rates back down again. So we got 50 basis points today. What are your thoughts on the path forward for the Fed?
I have to say I'm very impressed with the strength of the economy. I would have expected that the increases in interest rates that we've seen would have had more of an impact on the economy. The 30-year fixed mortgage rate, as an example, in the United States has more than doubled, and it has impacted real estate prices. My own expectation is that the impact of higher interest rates is likely a lagging indicator, which is to say that the impact of decreasing availability and affordability of credit will impact the economy at some point in time. But I do need to say that I'm impressed with the strength of the economy. I'm impressed with the ability of the Fed to raise interest rates. I'm impressed with the decreases in inflation that we have seen as a consequence of increased interest rates. And I need to say that so far, the policy has worked and worked on many levels. I don't approve of it because I don't think that the government should involve themselves in artificially manipulating interest rates. But I do need to say that I'm impressed with the resilience of the economy. I'm impressed with the market's seeming willingness to accommodate higher interest rates. And when I look at capital markets worldwide, but particularly in the United States and Canada, I am struck by the incredible amounts of cash on the sideline. if the Fed has the continued ability to raise interest rates without an immediate deleterious impact on the economy, I think that you may see, at least temporarily, a melt up as opposed to a melt down in capital markets, simply because there is so much cash on the sidelines. I believe, Charlotte, and I hope your listeners bear this contradiction in mind. In circumstances like this, in the near term, many investors and every government confuses liquidity, the fact that we have cash, with solvency, the ability to maintain our lifestyle and the ability to maintain our balance sheet over the long term. We have lots of liquidity right now. It's our solvency that concerns me.
Okay, and actually, I think that ties into another thing that I wanted to ask you about. This is something that came up in our last conversation when we were in New Orleans together. So one of your concerns at the time, you're mentioning retirement savings and that kind of thing. And this is something that I've now heard come up a lot of the time, whether it's about people's ability to save or people's ability to retire at the scale that they want to. So when we talk about these things, what are the considerations that you would want investors to keep in mind?
I don't know you well, Charlotte, but I suspect you're a fairly prudent person. I think that you've probably taken steps over the last 10 years to begin to ensure your own retirement, which is to say that you have saved for your own account in a vehicle, be it an RRSP or something else, that is your own, at least ostensibly, private property. Most Americans and Canadians haven't been that prudent. Most of Americans and Canadians believe that Canada Pension Plan and Social Security will be their savings. And many Americans and Canadians consign the investments in their retirement portfolios to the big thinkers, to other people. And where those pension and profit sharing plans have been invested in long-term bonds, I have real concerns. If you are the owner of a long-term bond where your interest payments are insufficient to protect your purchasing power, you have a real problem. Someone who retired in, say, 1970 with $250,000 was in very, very good shape. Somebody who retires in 2022 with $250,000 is functionally insolvent. What has happened is that $250,000 buys you markedly less today than it bought in 1970. And today's retirees need to understand that the same circumstance will happen going forward. So while I'm not concerned necessarily with Charlotte McLeod's retirement, because my suspicion is that she has looked after herself, I'm very concerned about the millions of Americans and Canadians who have trusted their retirement years to the big thinkers and will almost certainly be disappointed. I don't want Biden or Trudeau to manage my money. They have proven conclusively that they can't manage Canada's money or the United States money.
Right. And, you know, I asked you last year, I asked this question at the end of every year to the experts that I'm speaking with, is best advice for the year ahead. And you told us invest in yourself, which is kind of what I'm hearing come through again right now. I was going to ask if you had any further advice that you would add to that for this year, but it sounds like it may be just that.
Invest in yourself is always the best. Invest in your own education. If you have your own business, capitalize your own business before you do anything else. If you are building your financial future on a different platform, like you were doing at INN, make yourself the best person that you can be. Make yourself indispensable to your customers, and you will do okay over time if you don't make mistakes. My own belief in terms of your investments is that we run a substantial risk in the next 5 years of running into a recession. We haven't had one. In recession, we may or may not run into a liquidity crisis like we ran into in 2008, or like we threatened to run into in the COVID downturn. If we have a liquidity crisis, that is to say, if the financial institutions run into a trust problem and won't do trade with each other, in the absence of structural liquidity, you will have to have personal liquidity. I believe without a doubt, I'm talking about the fact that recession is a possibility, not a probability. I believe that increasing volatility, which is different than absolute risk, will be a real feature of markets going forward. And so I think that investors need to prepare themselves both for increased risk, but also increased volatility. And you do that in two fashions. One, I think investors need more liquidity in their portfolios, even though the liquidity costs them purchasing power. Having that liquidity will give you the tools to take advantage of illiquidity rather than being taken advantage of. And I think that investors also need to steel themselves. They need to invest in their own education and their own temperament so that they understand that volatility is different than risk. And risk isn't something that you should fear, but rather something that you should prepare for. So I would suggest the twin pillars of education and solvency are the two things that investors on a very grand scale need to think about for 2023. I also want to say, and I've pounded on this too many times, it's generated a lot of hate for me, particularly among my Canadian viewers. The government is not your friend. At the very best, they are an institution that shouldn't be counted on. But much more likely, they're an institution to be feared. When government officials talk to you about trying to buy your vote with some program, you need to understand that for the average working family in the United States and Canada, that expenditures on government exceed expenditures on food, on shelter, on energy, and on transportation combined. The idea that after they take 43% of your earnings, that they give you back a little bit does not make them either good or reliable sources for future stability. You have to do it yourself, and you have to do it in spite of them.
Okay, so I do hope that people take a listen to that and take it to heart. I want to take us back over to precious metals because I always like to check in with you on silver. So we know that silver has a contingent of very devoted people who follow it and love it. But we've also spoken before about, in general, it's kind of an unloved metal, at least at the moment. So we had recently projections for supply and demand come from the Silver Institute. Demand looking like in 2022, it will be up 16%, while supply stays about flat. So let's take a look at that. What does it take to move the price of silver?
I need to say to begin with that I don't know. When I look back over 50 years of investing and speculating in silver, what I know is that precious metals bull markets are led by gold. The fear buyer is first. The back half of a precious metals bull market tends to become silver dominant. And I don't know why, except for perhaps the lower purchase price relative to the same denomination. I don't know why, I just know that. I also know that silver's return to investors are crowded into a very small period of time over the course of a decade, perhaps 2 years. But if you're not in place, you don't enjoy the gain. What I really like about silver is the fact that it's unloved. As a speculative asset class, the fact that my ability to acquire it is enhanced by the fact that nobody else wants it is something that really increases its appeal to me. Charlotte, everybody wants to be a contrarian when it's popular, but there's a contradiction in that statement, which is to say, if the silver price were to go from 20 bucks an ounce to $50 an ounce, you'd see all sorts of people crowd into the silver market after it had run. People's expectation of the future is set by their experience in the immediate past. And people use the price moves as justification of the narrative. The problem with that is that the benefit that you get from the narrative has already been used up by the price move. So if there are people like myself who are attracted to the speculative appeal of silver, or the much more explosive speculative appeal of the limited number of viable silver stocks, you need to understand that you need to buy them when they're out of favor. You need to change your time preference. The fact that you bought it doesn't mean that you're going to get rewarded by Christmas. And you need to steel yourself too with the volatility that comes from volatile financial markets and you being early. You need to be able to withstand a substantial period of time when you're getting no emotional verification from price. For people who follow that stricture, which I've been able to do really since the middle part of the decade of the 80s, silver has been an occasionally frustrating, but overall very rewarding speculative activity for me. For people who are not able to manage their emotions in a way that tolerates volatility and also has the endurance to overcome a lack of near-term verification from price movements, those people should stay away from silver.
Yeah, no, I think you hit the nail on the head. It can be difficult to be early, I think. That's something that I see in the comments of our videos all the time. So useful advice. And speaking of comments, so for this interview, I did post to see what questions people might have for you. So we've got some viewer questions right now to go through, and I think they're pretty interesting. So one commenter mentioned that earlier this year, you said community banks were looking cheap. So this person wanted an update on the banks and financial sector from you.
You know, the banking business is the best business I know. It really, 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 truly is a wonderful business. It goes wrong because people become too aggressive. People make lower quality loans chasing yield. People allow the institution itself to become too leveraged. People don't run the cost side of the banking equation as well as they should. I've now been part of 7 de novo banks, startup banks. I'm on my 7th right now, Battle Bank. And I can tell you without qualification that the best business I've ever been associated with is banking. The headline numbers, if you think about it, are pretty good. Most banks, including most Canadian banks, would prefer not to pay you interest. The idea that they don't pay you interest on the credit balances in your checking accounts is insane. If you, as a bank, treat people fairly, which is to say, if you pay them fair deposit rates, the spread between your cost of capital, which is to say your deposit rate, and your return on capital employed, which is to say the rate that you lend at, is really, in a historic sense, very, very, very good right now. It's good enough that you can pay competitive deposit rates and simply reinvest the money in short-term treasuries and still generate a positive yield with absolutely no credit risk and absolutely no G&A. To the extent that you develop an expertise in lending money, the difference between deposit interest rates, let's call them 3% now, and typical prime rate oriented lending obligations, which are yielding in the 550 or 600 basis points area, suggests that you have a 300 basis point or 3% spread. A modern bank, a well-run bank that has a branch network should have non-interest expenses of about 1.25%, which suggests that you are generating a 20%. Well, let me say it differently. You are generating sort of a 12 to 15% rate of return after tax if you are only moderately successful. Many banks that I know right now are generating a 2% return on capital employed, but 90% of the capital they're employed is deposits, which means if they have 10% equity, they're earning a 20% return on equity because of the spread that they're generating on their deposits. This is a truly miraculous business. The idea that in a well-run community bank, and I realize that Canada doesn't have community banks, but in a well-run community bank, that you can enjoy 15 or 20% after-tax rates of return and reinvest that same money, growing your capital base at similar rates of return. This is a circumstance that's unmatched in any other industry that I'm aware of.
Okay, I think that was a great update. Now, another question that we had going in a totally different direction was about fertilizer companies. So we've talked about the fertilizer sector before, something that we've gone over. Maybe we could get your updated thoughts in the context of what's going on with Russia and Ukraine, because Russia is a large producer of
Yeah.
fertilizers. Your thoughts there?
Certainly the big fertilizer companies in the West, in particular the huge Canadian issuer Nutrien, have benefited from a reduced flow, in particular of potash, but also of ammonia-based fertilizers from Russia and Belarus. Certainly, too, if you have a cessation of hostility in the Ukraine, there will likely be a resumption of Russian shipments. The truth is that food prices on a global basis, viewed against historic norms, are insanely cheap. Food as a percentage of total household incomes has fallen from 30% when I was a young man to about 15% now. With the population growing and with the increasing living standards of the poorest of the poor, the 3 billion people on Earth who are classified as poor, increasing, I think that demand for conventional fertilizers will continue to grow. So although I think that producers like Nutrien would suffer in the near term in the event that peace broke out, which I hope it does, I suspect that those investors who are investing over the course of a decade will do very well. I continue to believe that countries with input capacities in countries like Canada, in particular in provinces like Saskatchewan, will receive a premium in equity markets to countries whose inputs come in sort of dodgier circumstances. An example, of course, would be Belarus or Russia.
Okay, and one more point on fertilizers. This person who asked that question mentioned a Norwegian company called Yara. I'm not sure how to pronounce the name. So I didn't know about this company. I looked it up and I saw that some recent news articles from this year, they were talking about how they actually had to cut production due to high energy prices. And so wanted to bring that up to you as well, because that really doesn't sound good when you're cutting production of this fertilizer that you need for food.
I think that Yara is a very well-run company, and the attention that Yara has gotten has been, ironically, that as they're a fairly high-cost producer, their margins increase faster when prices go up than efficient producers will, which is to say they have a higher leverage return to increases in fertilizer prices. I understand the benefits of optionality, and in the 1990s, I benefited from optionality. In my old age, I'm willing to give up some of my upside if you take away my downside. Companies like Nutrien are much more efficient producers, much more integrated producers. And although they don't enjoy the same margin expansion on the upside, they aren't penalized by the same margin contraction on the downside. So I'll take the higher quality company. I'll give away a bit of my upside in return for taking away most of my downside.
Okay, very interesting. So as we are wrapping up here, usually I ask for best advice. We already did that question. So maybe another one fun one is, if you had to choose a sector for 2023, what do you think is going to be the best performer?
I think that depends on who you are. I think if you are an income and value investor, particularly if you're Canadian, you stick in the Canadian oil and gas sector. I think despite the efforts of your prime minister to wreck the business, it's too good a business for him to wreck. I think if you're a speculator, that you probably look to the uranium business. I have said for years, talking to you, Charlotte, that an increase in the uranium price was inevitable, but maybe not imminent. I think now with the pace of Japanese restarts, it's imminent and inevitable. I think, too, because the uranium equities disappointed so many people, that while they aren't cheap, they also aren't expensive. So I think for the speculator, you look to the uranium space. I think to the investor, particularly if you're Canadian, you look to the oil and gas sector.
Okay, perfect. And I went in a precious metals direction this time because our last interview is quite a lot about uranium and energy. So we'll link that there in case people want to see those thoughts. And of course, we'll probably come back to that in the future. So I think that's all for me. Thank you so much for sitting down to talk about 2022 and what's coming up in 2023.
Always a pleasure, Charlotte. If I may reiterate my offer to your listeners, I invite any of them who want my opinion about their natural resource investments to go to my website, ruleinvestmentmedia.com. List your natural resource stocks there. Please no crypto, please no tech stocks, please no pot stocks. I'll rank them 1 to 10, 1 being best, 10 being worst. In addition, if you're a private placement investor, which is to say you're accredited, in the question and comment section, write down placements, and I will give you free notification of the private placements that I personally am participating in. And finally, if for some reason you don't think that you're well treated by your existing bank, if you think that, as an example, they ought to pay you interest, or they ought to loan you money against good collateral like gold, and you want to hear about my new bank, Battle Bank, in the question and comment section, simply write bank, and we'll put you on the list. And yes, by the way, we welcome Canadian business.
Okay, perfect. I hope that people will take you up on that offer. Thank you very much for coming on to talk and for offering those things once again.
My pleasure, Charlotte. I look forward to seeing you in Boca Raton at our conference this year.
Oh, I certainly hope so. Once again, I'm Charlotte McLeod with the Investing Network, and this is Rick Rule with Rule Investment Media.